Hi there. In this video I'm going to walk you through how to use retirement account funds to buy real estate. I'll teach you how to set up a self-directed retirement account, some rules to be aware of, and what accounts qualify. This video is being recorded exclusively for HouseCashin.com. My name is Ted Erickson. I've been helping clients use retirement account funds to buy real estate for 10 plus years. I'm the founder of My Direct IRA, where we specialize in setting up self-directed retirement plans that allow our clients to use existing retirement account funds like IRAs and 401ks to buy physical real estate. Now let's jump in.
If you want to sell your house very fast for cash, then HouseCashin gets the cash flowing.
I often get asked the question, can I buy real estate with my 401k? Yes and no. Your current 401k, if you called them, assuming you've got an account with one of the big boys, Fidelity, Charles Schwab, if you call them and say, can I buy real estate with my 401k? The answer is no. They're not built for it. They make money selling you stocks, bonds, and mutual funds. So if you call them, they're going to say no. The answer is you have to set up a self-directed 401k. That's obviously something we help with. Now, there's a number of different rules relating to can you access funds in your current 401k. A couple things to be aware of. First is the ugly question of age. If you're above the age of 59 and a half, most 401k plans will allow for you to take out some funds to invest in real estate through a different account, your self-directed 401k plan. There's also something called an in-service distribution, which essentially is asking your 401k provider, can I take out some dollars to direct towards other investments while I still work for this company? The third and most common is once you leave the job that provided you that 401k, let's say you retire, you quit, you get fired, those funds become immediately available for you to do a rollover into a new self-directed retirement plan to buy real estate. So I've used the term self-directed a couple times so far. Let's define that. A self-directed retirement account is a retirement account that allows you to invest your existing retirement account funds into private assets, like real estate, tax-free and penalty-free. So instead of taking your 401k funds out of the plan, paying taxes and paying penalties, a self-directed 401k allows for you to use the entire balance towards purchases of physical real estate. Now remember, if you call Fidelity and Charles Schwab, they're going to say no. You've got to take the dollars out, pay those taxes and penalties. The alternative is self-directed plans. That's what we help with. Many types of existing retirement plans will qualify for a rollover to a self-directed plan. That includes 401ks, 403bs, TSPs, 457s, Roth IRAs, traditional IRAs, SEP IRAs, the list goes on. Any account that is considered tax deferred would qualify to be converted to a self-directed plan. Now, in the self-directed world, there's a special type of account that we refer to as a checkbook 401k or checkbook IRA. This essentially allows for you to manage your retirement investments through the control of a business checking account. So picture this. You have a balance in your current retirement account plan. We can essentially help you move those dollars into a business checking account with an institution of your choosing so that you have direct access to your funds. That way when an investment property comes along that you want to pounce on, you can physically write the check yourself for an earnest money deposit or send a wire online, depending what your bank's going to allow for you to do. All of that done tax deferred, tax free, and penalty free. Now, there's a couple of different sets of rules you've got to be aware of when you're investing with your self-directed 401k. They fall under an umbrella term called prohibited transactions. And keep in mind, these rules are in play because when you have a self-directed 401k, you're given so much control and so much access to your funds, the IRS has to curtail your investment options just a little bit, essentially to ensure that you don't cheat them out of their taxes. Okay, The first and easiest to visualize in these prohibited transaction rules is called prohibited parties. What that essentially means is there's a group of individuals, a list, that your retirement account, your self-directed 401k, cannot transact with. So I'll give you that list. First, it's you, the account holder, your spouse, if you're married, any kids and grandkids you may have, and parents and grandparents, if you have them. So that list of individuals you cannot transact with using a retirement plan. And there's a number of ways that this can kind of present itself. So I get people calling me, for example, and they'll ask, "Hey Ted, my son's about to go off to college. I'm interested in buying a rental property near the campus, and I'd love for my son to live in the property and have a couple of their buddies pay rent to me." Unfortunately, that's going to be considered prohibited. That's because your son or daughter, whatever the case, is a prohibited party and cannot transact with your retirement account, a la pay rent to your retirement plan. The next question I typically get is, well, what if my son doesn't pay rent and there's no transaction there? Does that circumvent that rule? Unfortunately, no. What that does is it actually presents the next rule, which is considered or called improper benefit. And essentially what that means is you and your retirement account cannot improperly benefit by virtue of the other. And I'll give you a different example, or to build on the previous example. If your son, in that example of going to college, did not pay rent to your retirement plan, you as an individual would be benefiting by virtue of perhaps not having to cover that expense for your child. So that $1,000 a month that you might have had to endure, you're not having to. You are then improperly benefiting by virtue of a retirement plan investment. Okay. Another example is, "Hey Ted, my son's a contractor. Can I hire my son to come and do the work on a property to get it ready to go so I can sell it?" Again, the answer is no. Why? Because your son, in this case, is a prohibited party. Another example folks will ask of me is, "Ted, I've got a property. It's a great property. I want to sell it to my retirement plan, my self-directed 401k. Can I do that?" The answer is again no. Why? You as an individual are a prohibited party to your retirement plan. Now, there's a couple other ways that these rules present themselves. In general, if you're comfortable with the idea of prohibited parties and improper benefit, you're going to do just fine investing your retirement plan into real estate. Last but not least, let me show you how you're going to use your self-directed 401k to acquire real estate. First off, we have to ensure we're observing all of the prohibited transaction rules that I just laid out. A couple examples again, so we're not buying property from a prohibited party, yourself, family members, etc. We're not going to buy property that we intend to work on ourselves or hire a family member to work on. Again, that'd be breaking the prohibited party rules. So to start, we're going to observe all of those rules. So we're buying property from a third party. We're going to rent to a third party individual. And so that's going to ensure that you don't run afoul with any of the prohibited transaction rules to start. Next, I would say most important is the titling on the purchase agreement. So when you acquire a property that you're going to live in, you write John Smith, for example, on the buyer line. When you use your self-directed 401k, you're going to use the name of that self-directed 401k plan on the buyer line of your purchase agreement. Very important that you're using that titling, and or if you have a checkbook model, you're going to use the name of your LLC as the buyer for any purchase contract you're going to negotiate. That extends as well to any service providers you're going to engage. For example, a property management company. You're going to have that contract read the name of your 401k plan or the name of your LLC in that checkbook model. Same with any contractors, plumbers, landscapers, etc. In the name of your 401k is how you do business with those types of service providers. From there, the next most important piece to be aware of is financing. When you use a self-directed 401k plan to acquire real estate, and you do not have the capital available for the entirety of the purchase price, you're going to need to acquire a loan. In this world, it's called a non-recourse loan. That essentially means the loan is not based on your creditworthiness and your credit history as an individual. Like if you're buying a property to live in, that's what a loan's based off of. In this world with the self-directed 401k, the loan is based on the asset itself. So the sales comparables, the rent comparables are going to be the most important aspects to securing that non-recourse loan. So to review, we're going to observe all of the prohibited transaction rules. We're going to ensure that the titling on our purchase agreements and any other agreements we make are in the name of our 401k plan or the LLC for the checkbook model. And then lastly, for financing, you have to secure a non-recourse loan. Once you're comfortable with those items, really you're home free. Thank you for watching the video today. Again, my name is Ted Erickson. My Direct IRA is our company. Look forward to helping you in the future.
If you wanna sell your house very fast for cash, then HouseCashin gets the cash flowing.